Hi, I'm Jimmy. In this video, we're looking at Google stock. We have two different ticker symbols, GOOGL and GOOG. That's Class A and Class C. Now, there's also a Class B shares, but those are not publicly traded. We'll come back to this in a minute. So basically, in this video, what we're going to do is we're going to look quickly at the basics of Google's business. We're going to try to come up with an investment thesis for Google's business in general and look at some recent news and some recent developments about the company. Then we're going to try to come up with a fair value for Google stock. And finally, look to see, is Google's stock worth buying today? Is it worth selling? What do we want to do with it? Now, I personally own shares of Google. So for me, I'm questioning, do I take some profit here and sell out? Okay, now this entire analysis is going to be done over on the Investors Grow website, where first thing to take note of is that over the past year, well, Google stocks actually up about 20%, but not too bad. So where we're going to start is with Google segments. And you know what? While we're tackling segments, let's try to answer the question, what happens if the government tries to break up Alphabet? So there's been talk in the news recently about the potential that Alphabet, Google is a monopoly and therefore the company should be broken up. So what happens if they were to break up these segments into different businesses? Well, their first and largest segment is Google Search and Other. This is where they generate revenue for things like searches done on Google.com, or maybe the Google bar at the top of your browser, or maybe the advertisement revenue generated in Gmail or Google Maps. That's basically all that money ends up in this light blue category right here. That's the category that generates there. So, in theory, we're going to pretend like that is one piece of the business that gets spun off. Then their next segment, YouTube ads. Probably fairly self explanatory here. This is the revenue generated from YouTube ads. Okay. Then they have the Google Network, 10% of their revenue. Google Network is a lot like the advertisements on the Google platform. Uh, but with Google Network, it's all the different websites that use Google ads and then they split the revenue with Google. This is that revenue, the revenue that comes from non Google products or non Google websites that falls here. Okay, then we have Google subscriptions, platforms, and devices. Here we can think of things like Fitbit. They own Fitbit. They own Nest. All the different subscriptions that they have for their different businesses. All of that would fall into this category. And then finally, Google Cloud represents just 10% of revenue, but this is one of the faster growing segments of Google. But here we could easily imagine that Google's business could get broken into four different main businesses. Let's imagine Google Search is one business. Then we have YouTube is one. I'm going to keep Google Network tied in with Google Search. So we'll pretend like that's one. But then you have subscriptions, platforms, and devices as another business. And then finally, Google Cloud. Other bets is a very small percentage of their overall revenue, but we'll just keep that with their main Google search for now. But the idea here comes back to something known as a conglomerate discount. The idea of a conglomerate discount is that the sum of the individual parts is greater than when it's all put together. So, in theory, if you were to break up all the individual pieces, if they were to spin off, let's say, just YouTube as their own independent business, well, YouTube would be a lot more, it would be worth a lot more independently than it is as part of Google. To illustrate that, let's look real quick at the history, some recent history of the YouTube business. So this is a chart of revenue going back the past few years. Now they only have data going back to 2017 because before that, Google classified their revenue a little bit differently. They didn't break out the YouTube revenue like they do now. But what I would point out here is look at this most recent number. That's $31 billion in revenue as of the most recent fiscal year. That's a massive amount of money. To put that in perspective, 31 billion is more money than McDonald's generated last fiscal year. It's more than double what Fox generated from a, content creation standpoint. They more than doubled what Fox did. So, in theory, YouTube as its own independent business would be a massive business. When we jump over and look at Google Cloud, one of the faster growing parts of their business, well, not only is this one ramping up and now bigger than YouTube, the YouTube side of their business, but it's also growing at a massive amount. Could you imagine the premium that this company, if it was its own independent stock, what the premium would be that it would be trading for? Again, a lot of that gets lost in the conglomerate discount when it's all pushed together. So clearly, I think that if a company like Alphabet were to be broken up into individual businesses, I actually think that that's a pro for investors. Investors in general, if you go back to something like Rockefeller's Standard Oil, when Standard Oil got broken up, well, first off, a lot of the major American oil companies came out of Standard Oil, but Rockefeller got significantly richer when that happened. I think the story would play out very similarly with Google's business today. And just because we have the data up here, when we jump over, when we look at the geographic segments, well, I was actually surprised to see that the US generated a bit less than half of the revenue. Google's very much a global company, so it's not exposed to just the United States. But again, out of all the other segments, that is by far where most of the revenue is from, but it is less than total, it's less than half of total revenue. So just something to keep in the back of our mind. Okay, now let's jump over and look at some of Google's numbers. So we jump over to the financials tab, we click on a chart of revenue here. Well, here we can see that over the past few years, we can see that Google's revenue has grown an impressive amount. I mean, they went from 66 billion back here in 2014 up to 304 billion in 2023. So this was a massive climb higher over the past decade. Now, what about when we jump over and look at profit? Well, here we scroll down, we look at net income. Well, we can see that net income has also been incredibly consistent over the past decade. But what about net income margins? Net income margins are the percentage of revenue that's converted into profit. So here, $100 in revenue is converted into about $21 of profit. Same for the last year. $100 of revenue gets converted into $24 of profit. This company, Alphabet, has been incredibly consistent at being able to convert revenue into profit. This is impressive for any business. Now, we can also see when we jump down and look at shares outstanding, well, shares outstanding have decreased somewhat. Now, with this chart, because there are so many shares outstanding, it can be a little bit difficult to tell. So let's say we adjust this minimum value down to 12,000. We apply that here. Now you can see the numbers a little bit better. For a while, it was ramping up, and then it began ramping down. So overall, shares outstanding over the past few years, which makes a lot of sense for a company as large as Alphabet and as generating as much free cash flow as they have been, to be buying back some shares, especially when in some recent years, Alphabet stock has been somewhat undervalued. So them buying back stock actually makes a lot of sense. And by the way, just so we're all on the same page, these thousands are actually in millions. So 12,000 shares, actually 12 billion shares. 12 billion shares outstanding, give or take. That brings us back to the different share classes that they have. Okay, so now let's jump over to a pie chart which breaks out the three different classes of stock. Now, the key here to recognize is that for the different classes, it all breaks down to their voting rights. So Google Class A shares, GOOGL, gets one vote. Google Class C, GOOG, gets no voting rights. But Class B shares, which again are not publicly traded, Class B shares, which are held essentially by the insiders and the founders of the company, well, they get 10 votes. So essentially, their 10 votes can outvote everybody else, which is why you might notice that Google Class A and Google Class C, the two shares trade very near each other, despite the fact that one of them gets voting rights, the other one doesn't. Because of that, which one you buy really doesn't matter. Now, for me on a personal basis, I actually bought GOOG. And the reason I bought the class of stock that didn't have the voting rights was actually because at the time, Google was predominantly, up until that point, they were predominantly buying back shares in their Class C shares. So they were buying more GOOG than they were GOOGL. Since then, they've kind of remedied that and have been buying back both. But that was ultimately the reason. I wasn't overly concerned about the voting rights since Class B really has all the votes anyways. Okay, now jumping back to the Investors Grow website where we're looking at the fair value calculation for Google stock. Well, a couple things to keep in the back of our mind here. First, the reason I just brought up these shares outstanding is that this calculation is taking into account all three classes of stock, including Class B. It is assuming all three classes of stock are equally weighted. So in theory, they're each worth the same dollar amount. The reason that would happen is that If you look at Class B shares, which, yes, have a 10-to-1 voting right, but they're also convertible into Class A shares at a 1-to-1 rate. So for every one share of Class B that an insider might have, well, they can convert it to a single Class A share. Hence the reason, in theory, they're all about the same value. So, with that being said, we can see that going out the next 5 years using analyst estimates has the fair value of Google stock being real close to their current price. Now, just so we all understand what is happening, basically, is we are taking the free cash flow estimates for each year. Now, you can see in this year, when we mouse over, we can see that there are 36 different analysts that came up with this number. This number is the median number. So, the middle number out of all 36 analysts, what's the middle number? In this case, there's an even number of analysts, so they would take the middle two numbers, average them out. It's really that simple. But 36 is a lot of analysts. Going to the next year, we got 26, 16, 10, and then 7. Now, after this time period, the assumption is that it resorts back to our perpetual growth rate. In this case, I'm using a perpetual growth rate of 2.5%. I got that number because it's about, let's say, the long term average growth of the US economy. So, in theory, this company, Google, will grow as analysts have it growing. And then from there on out, forever, it'll grow at just 2.5%. Now, personally, I think that that's a little bit conservative, but I don't mind being conservative in my numbers when I'm trying to come up with a fair value for a particular company. So, Google stock right now is about fairly valued, but a minor pullback in this company could have this company worth, could have it undervalued a decent amount, and could be a good consideration for either maybe lower our average entry price or to perhaps jump into the stock if it's not a company we own yet, assuming, of course, it meets our portfolio standards and our portfolio mix, whatever that may be. Now, one of the possibilities we could argue with the required rate of return that I have. Right now, I'm using required rate of return of 9%. You can see that right up here. Now, I'm using 9% because that's a premium over AAA corporate bonds or even over, let's say, 30-year treasuries. It's a 4 or 5% premium over long term bond investments, which seems like a reasonable number to use. If AAA corporate bonds were to go significantly higher, they were 10, 12, 14%, well, I would have a consistent premium over that number. But as they fall, it kind of makes sense to reduce the required rate of return below that. Now, let's imagine you didn't want it to be 9%, perhaps 10% is a little closer in line with what you want. Well, if that's the case, fair value drops down to $140 a share. Add a margin of safety to that. Well, now you have an idea of where you want this, where you want to buy this company. Now, for me, on a personal basis, I take a more conservative number from a required rate of return. And then based on my analysis of the company, I add a margin of safety to it. So right now, at 9%, the fair value would be $161 per share. But I'd probably add a 10, 15% margin of safety to this stock. So I'm dropping it down a decent amount as to where I want to jump in and buy the company. But some people like to bake the margin of safety right into the required rate of return. So maybe you want a 12% 12% required rate of return. Maybe it's not all just return, but it's also the margin of safety. Well, if that's the case, you're waiting for the stock to get to $111 per share. So using a tool like this can often be a quick way to help us come up with the numbers that are most appropriate to see whether or not a company actually fits into our personal investment portfolio. So for me, on a personal basis, I'll be holding my shares of Google, hopefully for a real long time as the company continues to grow. And if they ever do break it up, hopefully we all do fairly well because of it. Now, if you're curious how to get access to this website, I will leave a link in the description below. And if you're curious how to research individual stocks, I actually did a video called 8 Steps to Analyze a Stock, basically how to do a deep dive on an individual company. If you're looking for that, I will leave a link right here and a link in the description below as well. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.